Good morning from London. I'm Kriti Gupta alongside Lizzy Burden and Mark Cudmore. We're an hour away from the opening trade. Here's what you need to know. Calling for a cut. Fed Governor Christopher Waller says the FOMC should cut interest rates this month to bolster a job market he described as on the edge. And charging China, the U.S. imposes anti-dumping duties of 93% on key battery materials from Beijing just days after a U-turn on chip restrictions. And it's another win for crypto. Congress passing a bill that regulates stablecoins, paving the way for broader adoption, but threatening traditional deposits. Lizzy.
Happy Friday, Kriti. It looks like we're going to head into the weekend on a high. You had the S&P and the Nasdaq setting closing highs yesterday off the back of that eco data. And we've got futures pointing higher on both sides of the Atlantic this morning. You mentioned that Fed speak from Christopher Waller, dovish, weighing on the dollar. But look, it's set to be the best month so far this year for the dollar. At the moment, euro dollar at a 116 handle. The countdown to the opening trade starts right now.
Happy Friday. Welcome to the opening trade. Lots to discuss. It's kind of a muted session already, but I think one of the key concerns here is what happens out of Washington. What is the fallout of the pressure coming on Jay Powell? And that takes us nicely to comments from Christopher Waller, the Fed governor there, talking about interest rate cuts as soon as this month. He's saying, in a completely contrarian take, that the job market needs it. Mark, your immediate thoughts?
I mean, he's been saying this for a long while, so, I think it's absolutely ridiculous. I don't think the job market justifies it. I don't think inflation justifies it. I don't think the market justifies it. It's like he's making a late pitch to be the next Fed governor and really kind of, kicking Powell while he's down really quite harshly. I think it's been quite a tense meeting at the end of this month. But I have to say, Valerie will get in. I'll be in trouble with Valerie later on if I don't mention. He's been saying this for months, so it's not really new. It's just an annoying time for Powell for him to emphasise it again.
It's like the Kevins were getting too much of the spotlight here. And Waller just needed to pipe up again. Yes, he's been saying it since April, but this is stronger language, right?
It is.
He said the labour market is near stall speed and flashing red. This is an extreme language for him, especially when you've just had jobless claims declining for a fifth straight week, but really setting up his dissent at the next meeting.
Well, the economic data piece, I think, is crucial as well, because there is an argument here that suggests, if you look at the CPI data, for example, that although it did come in hot, there is weakness there. You did see a bigger deceleration in certain pieces as well. You did see the private jobs market, as you pointed out, weakening as well. So there is an argument that if you were to take out the tariff risk, and if you're of the camp that the tariff read-through won't be as high, there are still pieces of underlying data that show weakness. The housing market is another example.
I just think it's a little bit too early to write off the tariff risk as one-off, because we just don't have any clarity there. So, and I think while the labour market is at stall speed, as you kind of say, Lizzie, or as Waller said, I think, it's... Given that with the cut down on immigration, we obviously still have low unemployment rate. It's a very, very tough market to be panicking to cut rates because the labour market just yet. Obviously, it is stalling. But it's not like there's going to be much slack in that market yet, and that's only going to feed to the inflation problem. So it's way too early to be cutting rates.
It was interesting as well that you had Larry Summers, of course, the former US Treasury Secretary, speaking to David Weston and saying that all of this pressure from the president on Chair Powell actually could drive inflation expectations higher and have the opposite effect. So continuing our conversation yesterday about the economic data, raising the bar for the Fed to cut rates, ironically, given that that's the opposite of what that's exactly what the president wants.
And we've seen an element of that, of course, in the break-even rates, at least around April as well. That has some of those moves have reversed as well. Let's talk a little bit about the tariff story, though, because that is an ongoing piece in the background. I think this is maybe the first day that we're starting the show without talking about trade.
Yeah, not agenda number one, but agenda number two today. So this is the US announcing that it's going to impose preliminary anti-dumping duties of 93.5% on graphite imports from China. Of course, this is a key ingredient when it comes to making batteries for electric vehicles. This is horrible news if you're Tesla and you saw the stock falling yesterday. Is this really about China, or is this really about EVs and the beef with Musk, when you've got reports that, Trump is softening his stance behind the scenes when it comes to China, and you've got the softening of the stance when it comes to chips and sending H20 chips to China as well?
So I think there's both the short-term trade, which we're kind of trading the direct headlines and this stuff, so we're trading both the EV story and the kind of the China story. I think people are taking the longer-term picture that Trump is expecting or aiming for a very good deal with China. So very different from the narrative 6-9 months ago that China was going to be the main victim of tariffs. People are increasingly, when I say increasingly, from a low base, but it's a very sizable minority, are growing into the idea that China is going to be one of the big winners out of Trump's tariff policy. I'm a little bit worried that reaching that conclusion too early. I just don't know how we can have any clarity on what the tariff plan is. So I wouldn't want, and as you know, I'm a long-term kind of China bull on the market side, and yet I think that's kind of a narrative that might get a real big comeuppance in a couple of weeks.
Well, maybe one of the key dollar bear cases is simply that you won't see a sustained reversal in the dollar outside of these tiny retracements until you get that trade deal between the United States and China. The rest just simply don't matter. And we talk about this kind of tension, this push and pull in terms of the rhetoric and the olive branch, or I say even the tension between the world's two largest economies. There's another piece of this to keep in mind. In the last couple of days, we've heard reports that Wells Fargo, one of their bankers that was visiting China, was actually stopped from exiting the country. So suddenly there's a corporate element to this as well, to the point that Wells Fargo, which is one of the largest banks in the United States, have stopped their travel to China altogether. And this is a really big deal. The woman in question was someone who specifically navigated trade and trade receipts and trade financing. So that is certainly one to keep an eye on. There's another major asset class moving, though, as well, and those are cryptocurrencies.
You're going to get me to talk about crypto as the crypto cynic. Yeah, look, it's crypto week, and it's delivered. It's, delivered to hype. I think we've had the big stablecoin legislation passed in the US. I think what's really important to take away here is that this is another massive stamp of approval for the kind of crypto sector from the financial industry. It's not about Bitcoin this time, which most of them have been about. It's much more about kind of the altcoins. We've seen real outperformance from things like Ripple, Solana, Ether. There's a couple other things playing into that. So I thought it was interesting that in context this week, Donald Trump Jr. is involved with another company that's another kind of crypto treasury company that's got 250 million signed off to invest in crypto. Thumbs Up Media overnight. We are expecting to get the kind of launch of a new futures product, ETF futures product for Ripple later on today, which is helping the kind of Ripple outperformance that we're seeing. It's the real kind of massive one at the moment. So I think there's a lot going on around this crypto week. I have to say, it's a very, very supportive time for crypto, given that we're undermining the dollar, we're undermining real yields, we're undermining institutional credibility. We've got the administration of the most important economy in the world very enthusiastically endorsing crypto at both a personal level, very heavily invested, and at an institutional level. You can't really get much better than this for crypto. So I think it's a pretty good tailwind for crypto. Then again, we did know this was crypto week. How much was priced in? Probably not all of it yet, but we might be getting a short-term zenith in euphoria.
Yeah, it's interesting. We're going to be having a conversation with a private equity investor later on who's heavily invested in fintech, and really the concerns highlighted by the likes of Jamie Dimon about the threat from fintech to traditional banking. Just illustrated here, this could not be more bringing crypto into the mainstream, but also the fact that this is set to continue, right? You talk about how Trump is championing this industry. The FT reporting today that Trump's preparing to open the US retirement market to crypto investments as well. So this is only set to go further.
I think what's crucial here as well is that this was a bipartisan bill. Yes, you got criticism from the left, naturally, because it was a Trump-sponsored bill and a GOP-led bill. But this still got bipartisan backing, because I think there's a recognition here that this is a market that has gone quite far, unregulated, and this is the first landmark regulation, really, to kind of rein in some of that outperformance. So we're going to continue to monitor that story throughout the show. And as we go, let's tell you what we've got coming up on the show today, though. We've got an all-star lineup. Gustavo Medeiros, Ashmore Group's head of research, will be joining the program in just a few minutes. We'll get his take on the markets alongside Sam Linton-Brown, BNP Paribas Markets 360 head of global macro strategy. All the story from Chris Waller. We're going to digest what that means for the markets, but also what it means for the economy. Chris Watling, Longview Economics, will be weighing in about whether this economy, this global economy, actually needs rate cuts. Plus, of course, Jane Foley of Rabobank, head of FX strategy, maybe to count us down to another major election around the world. And that, of course, is in Japan. What does that do for those Asian markets? From the G20 as well, we are live. We're going to hear from the OECD Secretary General Matthias Corman and Jim Chalmers, the Australian Treasurer, as well.
It's a busy day on the docket as well, though, Kriti. We've still got plenty to come. We've got at 12 p.m. London time, American Express's second quarter earnings release. Then at 3 p.m. London time, we get the University of Michigan sentiment data, expected to have continued improving into early July. But, of course, you've got all that tariff uncertainty around the July 9th deadline that was pushed back. You mentioned the G20 finance ministers meeting happening in South Africa. Can they get a communique? We've heard from the South African Finance Minister telling our very own Jennifer Sabasaja that that will emerge today. And then, as you say, on Sunday we have the Japanese upper house elections. What's that going to mean for the yen? So plenty to watch out for today and out of the weekend.
Absolutely, lots going on. Let's talk about some headlines breaking the Bloomberg terminal. That, of course, is in the luxury space. Burberry's first quarter retail comp sales coming in negative, but not as negative as expected, down about 1%. The estimate there was minus 3.7%. We know that Burberry has struggled with their sales story for some time, but a negative number that isn't so bad may actually create some gains when it comes to that market open. So that's going to be something we digest in a few minutes, or at least say 50 minutes before the open. It's going to be a crucial one, certainly, if it sets the tone for some of the other luxury names trading this morning as well. Here's what else you need to know when it comes to this morning's agenda. Speaking of earnings, Netflix beat expectations across the board in the second quarter, posting revenue of $11.1 billion. It also raised full-year guidance, forecasting $45 billion in sales and a near 30% margin. The company's market cap now exceeds $500 billion as it leans into content and ads amid rising global competition. The weakness in the dollar, also a key story for that company. Right here in the UK, Prime Minister Keir Starmer hinted the UK may join Germany in purchasing weapons from the United States to give to Ukraine. Sources say talks to join the proposal are still in early stages. The discussions come as Western allies seek to shore up Ukraine's defenses in its war against Russia. Man Group has cut jobs for the second time in a year and reshuffled its leadership as management continues to overhaul the world's biggest publicly listed hedge fund firm. The London-based company told staff in a memo that Greg Bond, Chief Executive Officer of Man Numeric, will become the new Chief Investment Officer for the group in a newly created role. Man says it made a small reduction in its global headcount.
Well, coming up on the programme, we're going to talk private capital and the global investment climate with Udayan Goyal, who is from Apis Partners. And then we're also going to be talking about defence spending, boosting SAAB's outlook as well. We're checking on the Swedish company shares at the open. But up next, the Fed's Christopher Waller joining the White House in calling for immediate Fed cuts. Could he be in for a promotion? We'll discuss next. If you've got any questions for any of our guests, please do send them in on IB plus BBTV Go. This is Bloomberg.
I believe that the Federal Open Market Committee, or FOMC, should reduce our policy rate by 25 basis points at our next meeting. So with inflation near target and upside risk to inflation limited, we should not wait until the labor market deteriorates before we cut the policy rate.
Has President Trump or anybody from his administration talked to you about potentially taking Powell's role?
Nope.
Fed Governor Christopher Waller there. Let's bring in Bloomberg's Valerie Teitel for more. Val, he's been singing from this hymn sheet since April, but how much of a step up is this language from Waller?
Yeah, some pretty stark language from Fed Governor Waller, calling that the labor market is basically screaming out for a rate cut, seeing it on edge. And you might say, wait a second, didn't NFP beat last month around? Aren't jobless claims declining? But in his mind, you have to do some adjustments to that headline number. And he sees that private payrolls are basically running around zero or basically in slight contraction. If you take the June NFP, it was around 147K. He wants to take out those government job additions, which were around 70K. And he wants to take away these anticipated revisions from the BLS. This was something that happened last year. The BLS revised down NFP around 80K a month. So he is already subtracting those anticipated revisions from the headline figure. And he sees the labor market essentially in decline, in contraction. This is one of the main reasons why he is calling for a cut. He is not worried about inflation from tariffs. That is something he has been arguing since April. But then it comes to jobless claims. They came in decent yesterday, declining for a fifth straight week, the lowest since April. And that streak, we have not seen something similar for around 3 years. But in his mind, this data is being heavily distorted by Trump's stark immigration policy. That could be something that is basically changing this kind of data. We're having foreign-born workers leaving the labor force. That is distorting this weekly data. And he is way more focused on the downside risks to growth. Kriti.
Bloomberg's Valerie Titel walking us through the case that Chris Waller is making when it comes to a potential interest rate cut as soon as the end of this month. Let's bring in Gustavo Medeiros, head of research over Ashmore Group, who, of course, is not only watching every move that Jay Powell makes, but the ripple effects around the world as well. Gustavo, let's start with the policy out of Washington here. How do you position for a potential shift, whether it's in terms of a shift in leadership from Jay Powell onto Chris Waller or any other contenders, or an actual shift in the interest rate policy itself based on tariffs or weakness or whatever?
Yeah, there's a lot to unpack in there, but I think there will be two very different shifts. A shift in an aggressive and abrupt shift from Jay Powell position outside of the expectation. I think it would be a shock to the market because the market would take it as potential interference from the executive administration in the central bank. We invest in emerging markets. I've been investing in emerging markets for more than 20 years, and we're quite familiar with some of these. And what happens is obviously the curve should steepen significantly, risk assets should sell off within that country, and the currency of that country should sell off and should underperform significantly. Obviously, there will be quite a lot of volatility, and that's not necessarily positive for emerging markets, but I think the currency element would anchor asset prices there. Now, I think what Christopher Waller is saying is, I wouldn't take it as political. If you've been following Christopher Waller, he's been very early, more than a year ago, he was talking about the concept of as inflation comes down, if you keep your Fed fund rate at too elevated levels, your real interest rate would increase far too much. And then you go from a policy that is already tight to overly tight. So he's been advocating to slowly and gradually cut interest rates as inflation declines. In the last couple of inflation prints, despite the expectations of higher tariffs, you didn't see quite a lot of that. Why? Because goods is the smaller part of the CPI basket, because the service side of the economy, particularly housing, etc., has been starting to soften up. That's been compensated. And there's also the fact that we are in a very different environment than we were the last time that we had an inflation shock during the pandemic. Back then, we had a major supply shock and a major demand shock happening at the same time. This time around, if you do have a supply shock that is much more targeted towards some goods, some specific goods, or towards all goods, what you typically have is that the service sector of the economy slows down to compensate for that because your disposable income is not increasing significantly. So I have some sympathy for the way Christopher Waller is thinking. This time, calling inflation transitory is much more appropriate than it would have been, than it was when they called it for the first time. And I think obviously that catches the eye of the administration as well, right? Because
Gustavo,
more in line with them.
You made a key point there, which is that perhaps the increases offset the decreases, the weakening in the housing market, et cetera, offset any sort of inflationary shock, even whether it is transitory or sustained. But talk to us about the weakness, though. When we're the places of the inflation data where we are seeing the actual weakness or the pullback, there's a question in this market of how big of the ripple effect there is. For example, housing market weakness is happening in tier 2 cities. It doesn't necessarily reflect on the places that are more population dense, as one example. There are other parts that are starting to pull back, like food prices, for example, which are a function of avian flu and things like that. How relevant are those pullbacks to the broader economic growth picture?
Yeah, again, so there is a lot happening in the economy, and I think that the best way of characterizing it is this K-shaped recovery, right? Where you have the pockets of the economy where have termed out the debt and have a lot of cash that are benefiting from high interest rates and high asset prices, but the parts of the economy that are more indebted and have more, exposure to interest rates, real estate markets, small businesses, the lower part of the income population, these guys are really struggling, right? So every time you try to do the analysis of the macroeconomy of the U.S., it does feel like part of the economy has been in a 2-3 year rolling recession, and the other part of the economy has actually doing extremely well, and financial markets are picking up kind of like, following a little bit of the upper side of the K, right? Because of it's a market cap weighted kind of like, index. So I think that the economy is okay at the moment. There's a lot of policy changes that are happening that brings uncertainty in immigration, in tariffs, etc. But that seems to be digested so far well.
Gustavo, you can slice and dice it how you like, but we're talking about whether Waller wants to audition to be the Fed chair. We talked about whether he's annoyed that the Kevins are stealing the limelight. Who would the market see as the most credible next Fed chair?
I think the market would quite like Christopher Waller because he is a well-known character. He's actually been, in my mind, the intellectual mind behind the recent cycle, right? And you can make the case that, yeah, the Fed made a policy mistake during the pandemic, but then they've been actually trying hard to compensate for that. And I think Christopher Waller has been steering the ship quite well. I think Kevin Warr should have been, would have taken well. He has some experience in the Fed, his experience with crisis. I don't think he's a bad candidate either. I find it hard to nuance what would be the differences, but I think that the market initially would pick up on this idea that Fed fund rate could be much lower next year than what it's priced in, right? And that is, I think, the main signal that we should be looking for here, which is going to be important for emerging market assets and asset prices elsewhere.
Gustavo, I wonder whether it's a sign of the times that we get on the head of research for this massive EM fund, and all we do is talk about US policy. Is that our newest emerging market? Look, I want to go to real emerging markets. I'm really interested. How do you see the Brazil story playing out? Obviously the big tariff standoff now between the US and Brazil. There's an election next year. Brazil suddenly getting real exciting narrative again. It's got this big external debt problem, but that gets eased by dollar depreciation. There's a lot going on here. I've kind of come from the backdrop of being very bullish, but I'm a little bit worried about the path of the next 6 months. How did you see it playing out?
Yeah, well, in a nutshell, Brazilian asset prices and Latin American asset prices in general, at the end of last year, they were far too low, far too weak, right? And I was in a conference here in London with a bunch of other fund managers, and I was the only guy that was saying, guys, Brazilian asset prices are far too cheap to ignore, right? And everybody was looking at the negative fundamental side, the fiscal accounts, etc. I think the main catalyst for Latin America in general is that from December this year, with elections in Chile, until October next year, elections in Brazil, you had 4 major economies that are having elections. And the population is tired of things that didn't work, and what didn't work in Latin America recently have been the leftist regimes, right? So you have this potential shift from the leftist populist policymakers towards the right or the center right. There are going to be, all of them will be messy races because there will be all fragmented. So you see Brazil go the same way next year? So that's how people have been thinking about Brazil, and that's why Brazilian asset prices partially have been performing quite well. First, it's very low. Second, the carry is very good if you're buying local bonds. Asset prices and equities was very, very cheap as well. The currency was very cheap. So people were buying into that and starting to buy in anticipation of that. We've been thinking perhaps it's a little bit too early to buy in the first half of this year Brazil because of the election, but that's how the market is started positioning.
So, okay, we've only got a little bit of time left because you talked too long on US. So, very quickly, how low do you think dollar Brazil can get in the next 14 months before the election? It's a bit more than 14 months. Well,
yeah, it's going to depend on how the race is going to look like, right? And that's, I think, the tariffs, the main problem of the tariffs is that it really gives a little bit of ammunition for Lula, for the current administration, to actually say, look, these guys are actually trying to mess up with our economy. We've been doing a pretty good job. And that muddles a little bit the catalyst that I mentioned, the election catalyst that I mentioned. But elsewhere, I think that you probably want to take advantage of any volatility in the summer to add exposure to Brazil and to other emerging market economies.
All right, Gustavo, so good to have you around the table. Gustavo Madeiros, Head of Research over at Ashmore Group. Thank you so much. Coming up on the programme, we're going to keep talking currencies. The dollar edging lower after Fed Governor Christopher Waller calls for a rate cut this month. We'll discuss with Sam Linton-Brown from BNP Paribas Markets 360. That's next. This is Bloomberg.
Minutes away from the start of the opening trade across Europe. Futures are pointed higher. I wouldn't call it a major risk-on kind of moment, but still higher by 0.4%. Not too shabby for the Euro Stoxx 50 futures. A little bit of outperformance on the continent. The CAC 40 futures, I think, are interesting, higher by 0.4%. But the FTSE 100, Lizzie, in on the party.
Yeah, not a whole lot of movement either on your bond space. Yields ever so slightly higher across the board, across the continent, but a different story stateside, Mark, when you look at the Treasury picture.
Yes, yields slightly lower. 30-year yields back below 5%. As you know, I'm quite concerned that we're going to go see 18-year highs there within 20 basis points on the 30-year. I still think we're going to go see steepness there. But no one cares about my view. And we've got Sam Linton-Brown here, who is Head of Global Macro Strategy at BNP Markets 360. So tell me, what do you think we're going to get yields? Are we going to get those 18-year highs in 30 years soon in the US curve? And how worried are you about US Treasuries?
I wouldn't rule it out. It's certainly possible. As you say, we're not that far away. It's just 20 basis points, which in the context of how much the market's moving these days isn't that big of a further sell-off from here. I think the key event that I'd highlight as it relates to Treasuries is 31st of July. We have the refunding announcement from the Treasury in the US. This is going to be super important for the market. What we expect is a bit of pushback from the Treasury to market pressure to long-end rates. The way that we think they can do that is by suggesting future increases in issuance are going to come from bills, very short-dated, rather than from bonds. At the same time, we think they might announce bigger buybacks and skew those buybacks a bit more longer-dated. So some attempted pushback here to the market pressures to the long end.
I mean, the thing is, a lot of the market's expecting that move to the front end. That kind of juices the market again. From a stock's point of view, that's got to make you quite bullish, right? Because ultimately, they did this before a few years ago, obviously, you know, this is going to really, really juice the market with long-term consequences. Do you think that means that equities kind of run through higher through the tariff deadline in August because of this?
We do. We're bullish stocks. A key element here is also positioning. Our proprietary quantitative positioning metrics that we run at BNP Paribas show the market is not that heavily invested in stocks either in the US or Europe at the moment. The market positioning is actually quite neutral. So we've had some re-risking after the big April 2nd Liberation Day de-risking, but it's not to the point where positioning is a constraint for further gains in stocks.
Sam, I was interested in your notes that you don't see the Fed cutting at all this year. Do you think that they would have been able to if the Fed had had the certainty on tariffs, if Trump hadn't delayed the tariff deadline from July 9th to August 1st?
We haven't been expecting Fed cuts in 2025. Since November 2024. So it's been a long-held view. Our framework for thinking about it is that tariffs are going to drive a price increase. We're already seeing that quite evidently in the data, for example, earlier this week in core goods. The question then, and this ties into, I think, what Waller is saying is, does that price shock prove persistent or is it one-off? Our view is because the labour market in the US is actually very tight. You have an unemployment rate of 4.1%. That's below where the Fed see neutral. It's well below where the Fed are forecasting it to be at the end of this year. They have 4.5%. It means that the likelihood of second-round effects isn't that small, especially with inflation expectations that aren't as well anchored as they've been in the recent past. So what that means is we think it's a Fed which has to be quite cautious. So they keep policy on hold either until they see weakness in the labour market or until they're confident the peak in inflation is behind us.
Well, yeah, we've talked about how it maybe has raised the bar on the economic data to cut because of the pressure on Powell to cut from the White House. Jamie Dimon raised the prospect of maybe a hike. What chances do you put on that?
Earlier in the year, we felt like at one point a hike was looking almost as probable as a cut. I wouldn't say that's where we are today. Hikes seem quite unlikely, although not implausible in a scenario where we continue to see tariffs drive inflation higher and second-round feed-through due to a tight labour market and not super well-anchored long-term inflation expectations.
But Sam, we keep waiting for that moment. We keep waiting for tariffs to have some sort of ripple effect. It's now been 3 months, and over 3 months, and we haven't seen it shown up yet. Is that something that the markets are actively positioning for?
I think we have seen it show up. I think we saw it quite evidently on Tuesday. Core goods, if you take out autos, printed at a level that it was printing during the pandemic. So we're seeing meaningful tariff feed through to inflation now. And I think that's why over the past 48 hours we've seen this move higher in yields. You mentioned the 5% in 30-year. We've also seen the front end reprice higher. That repricing has really been driven by inflation expectations. So the market is now discounting higher inflation over the next year and a half. Where our view begins to differ from what the market prices is the persistence of that. The market thinks we're going to spike higher and then we're going to come off quite quickly. Our view is that retracement might be a little more slow because of the tightness of the US labour market.
And is that, you said the market's not bracing for that possibility, the persistent inflation threat. What does that look like in terms of how does it show up in markets?
It should show up in 2026 inflation fixings, especially in the second half of the year going higher, reflecting higher inflation expectations. It could also be reflected in expectations for the Fed, where we still price some probability of further cuts this year, not as many as we've been pricing previously, but there's still 2 cuts or so embedded, that coming out as well.
Sam, I saw your notes of your recent views before the show, and I was really disappointed because we agree on almost everything, which is just really annoying.
Where do we disagree?
Well, exactly. That's what I want to focus in. So there's a few things, and I'll give you a choice which one you want to argue most vociferously. We agree on euro-dollar, but I think your target's very boring. 120 if you're in. Oh, come on. Let's be a bit more ambitious, but fine, we'll stick with that for the moment. The two other bits I want to ask about is, you talked about being bullish stocks in the short term just because of the positioning. Institutional markets not really on board with this. One of the things I very firmly believe in is that we've seen the end of US stock market outperformance, US exceptionalism from that point of view. And part of that is because of the currency view, because I think that the long-term dollar decline. So the rest of the world will outperform the US stocks in the next couple of years. We've seen the share of US stock market fall from 50.86% about 5.5 months ago to about 48.4% now. And I kind of think that's the start of a kind of long-term kind of decline, but not in a bearish view in the US stocks. I want to ask you on that one, and on a slightly different note, I was really surprised. The one thing that caught me from your notes, you like steepening most in Europe, which is actually the opposite of what many people think.
Okay, I'll try to address all three of them very quickly.
Oh, nice, brilliant.
So
I cheated there.
Euro-dollar 120 this year, 125 next year. It's aggressive, I'd say, relative to when we projected it, which was in February, where euro was sub 110. US versus European stocks. I think fundamentally it comes down to AI and to tech, because if that's going to be the secular theme, then really that's much more a US story. From a macro perspective, we're also positive on Europe. So we don't have a super high conviction cross-regional view between the two. We're bullish on both. On the curve in Europe. So here, there's two important stories. The first is fiscal in Germany. This is a massive, massive structural change. 4 years from now, Germany is going to be issuing more than double the bonds in net terms that it issues currently. That's a huge, huge change. That's going to drive yields higher, steeper. The other factor that's very important is pension fund reform in the Netherlands. There's some regulatory change that means there's going to be large paying in the back end of the euro swaps curve. There's already been a big steepening in Europe. 10s, 30s used to be minus 15 bips earlier this year, towards the end of last year. It's now plus 20. So it's been a big repricing already. But when we look at that curve compared, for example, to Japan, to the UK, it's still flat. And we think that can continue to steepen.
All right, Sam Linton-Brown, head of global macro strategy at BNP Paribas Markets 360, walking us through the dynamics in this market. We thank you so much. As he was speaking, we did get some headlines crossing the Bloomberg terminal as well. This coming despite from the European Union, the EU agreeing that new Russia sanctions will include the lower oil price cap. Now, this is really significant here because, of course, this comes as the 18th round. It's been in discussions for quite some time with the European Union. This comes after Slovakia, which has been the major holdout for the sanctions package, actually accepted guarantees from the European Union. We know they've been aligned with the likes of Viktor Orban out of Hungary when it comes to that Russian supply. They've had a turnaround in exchange for some financing as well, to the point that we are now getting an 18th round of sanctions from the European Union on those Russian gas supplies. And that's going to be something that's reflected in these markets as well, given that includes a lower oil price cap, pushing the price of Brent crude just a little bit higher, crossing the $70 a barrel dynamic. And of course, that's going to be something that feeds into the global inflation story. And that matters quite a little bit when we talk about the pricing, coming right back to what Sam was talking about, when it comes to that persistent inflation. The energy story in Europe, still very much a concern on both sides of the Atlantic.
Yeah, absolutely. I think it's only a short-term concern, though. I think that the longer-term story here is that we have supply waiting to come on the sidelines. And, I think a story that's got very little attention as a kind of tail risk on the whole energy story is that Trump's 50-day deadline on Russia, everyone's kind of dismissed it and scoffed it because there's been so many deadlines missed in that story.
You're not saying taco, are you?
Well, no, I'm not. But I'm not even that. But I think the point is here, quite importantly, is that, from Russia's point of view, it makes sense to if you're going to stall it at some point soon, you're going to stall it into the winter. So push for gains before the summer, into the summer, stall into the winter. And then if you take that, we're finally seeing intense pressure on the Russian economy. I think a tail risk that markets are maybe not giving much attention to, and maybe this is a little bit speculative, is that Trump's 50-day deadline ends out roughly working or with a small margin, and we actually get some development there. If that happens, you're going to see oil and gas prices absolutely collapse, not because supply immediately comes onto the market, but just because of forward pricing and sentiment.
And so much of the hedging that you've already seen that have been kind of taken into perhaps the geopolitical risk that we saw in Iran and Israel as well, a lot of that pricing has been locked in. So a collapse is something that a lot of folks in the industry are actually talking about. As we talk about that, it looks like the EU's Kaja Kallas, the number 2, of course, at the European Commission, saying the sanctions will include the biggest Rosneft refinery in India. This is a really big deal, given that Donald Trump has talked about secondary sanctions, or what he calls tariffs, when it comes to the likes of countries that are supporting any sort of Russian oil output. And of course, China and India has been at the top of that list. But again, it all comes right back down to the inflation story. And for that, we have the perfect conversation for you. You can tune into Surveillance today over in the States for that. Fed's Christopher Waller, the heart of the inflation conversation this morning, will be joining Bloomberg after his comments earlier in yesterday's session. 1 p.m. London time, 8 a.m. New York. That is certainly a conversation you want to tune in for. Coming up on the program, we are headed to South Africa, where they are calling for greater cooperation among the group of 20 advanced economies. We're speaking with OECD Secretary General Matthias Corman next. Stick with us. This is Bloomberg.
We're just over 15 minutes away from the opening trade, and South Africa is calling for greater cooperation among the G20 economies as finance ministers and central bank governors gather under the cloud of President Trump's trade war. Despite the global trade concerns, the country's finance minister says the group is nearing a deal on a communique. It'll be the first time in about 4 years, I think. And for more, Bloomberg's Oliver Crook joins us on the ground from Ballito in South Africa. Ollie, over to you.
Yeah, that's right, Lizzie. We're here. I'm outside of Durban in South Africa for the convening of the finance ministers of the G20 and the central bank governors, really sort of overshadowed in large part with a lot of the macro developments in the world, namely Trump's trade war, but also his questions about Fed independence and the potential shockwaves that could send across the planet in terms of global financial stability. And, of course, this question of multilateralism and its future in the absence, seemingly, of the United States. And we're very pleased to be joined now by Matthias Corman, who is the Secretary General of the OECD, and who's got a pretty unique view in terms of the picture for sort of the global growth at the moment and all of the risks that are sort of that are being posed to it. At this stage, what are the different sort of models, the different outcomes that you're seeing for global growth, just given the different possible outcomes we can get from this trade war with the United States?
Well, we have recently released our economic outlook for the global economy, and compared to what we forecast back in December or even earlier this year, we have further downgraded our outlook for growth, and indeed we're expecting inflation to remain higher for longer and to come down more slowly. I mean, it is clear that there is a high level of uncertainty in the global economy, a high level of policy uncertainty, increasing trade restrictions, tightening financial conditions. All of that is weighing on consumer and business confidence, and hence, having a negative impact on the investment and growth outlook.
And also thinking about the sort of political dimension of this and the sort of moving away from the United States, from the multilateral order, is there a risk associated, do you think, with basically this breaking out into kind of a G6 world versus a kind of BRICS world? And then there's this sort of G20 that sits in the middle trying to bring these things together. What's the risk of that sort of world?
Well, I mean, I've just come out of a G7 finance ministers meeting, and I think the G7 is working very constructively and very cooperatively. I certainly don't see that risk. And next year, the United States will be chairing the G20. So, I mean, I think the US will continue to be a very important contributor to global conversations on key policy issues. Now, I mean, right now, there's clearly an area where there is a level of disagreement. There's some issues to be resolved when it comes to global trade arrangements. I mean, there's no question that open markets and rules-based trade have been a key driver of increased incomes and living standards around the world. But it's also true that there are some issues to be resolved when it comes to the rules-based trading system. I guess what we're saying from an OECD point of view to countries around the world is work those issues through on the basis of dialogue and cooperation, work those issues through and find ways to make global trading arrangements or international trading arrangements fairer and work better in a way that preserves the economic benefits of open markets and rules-based trade.
And if you just got off that call with the G7, you spoke presumably also with Scott Bessent on that call. What was the message there? What kind of insight can you give into the American position?
What I can say is that G7 countries continue to think very carefully about the challenges and opportunities in the global economy and work together in a very cooperative and constructive way in trying to deal with some of those issues like supply chain resilience-related challenges, economic security-related challenges, issues around unfair trade practices and how best to tackle them. But I guess the key focus here is, I mean, it is important for the global economy and to boost the global economic outlook to as quickly as possible restore policy certainty, as well as dealing with some of the structural challenges in front of us.
And you're not just an observer of the global economy, you're also a participant in some of the initiatives, namely the global minimum tax initiative that has been sort of launched a few years ago, had a lot of momentum under Biden, had lost some of that momentum under Trump with some carve-outs for the United States. I'd like to get an update from you on where we stand with that today.
Well, I mean, that's not quite right the way you frame that. I mean, the United States has had a global minimum tax in place for some time. It was introduced under the first Trump administration, and the OECD global minimum tax, which is now being legislated or is in the process of being legislated by 67 countries around the world, and more countries coming on board, is also a reality. So what's been happening is that at the G7, again, I mean, there have been a lot of conversations about how to manage in the most appropriate way a side-by-side arrangement between the US version of the global minimum tax and the global minimum tax, which was negotiated through the OECD G20 inclusive framework. And I mean, the United States continues to be subject to key aspects of the OECD G20 version of the global minimum tax, but there are also some pragmatic approaches to ensure that there is not an unnecessary level of double up when it comes to the imposition of global minimum tax arrangements.
So I guess there was a concern after this G7 meeting, and there was a bit of a carve-out, that there was a two-tiered system where the United States would play by slightly different rules. So are you saying that that has basically not altered in any way the participation of other countries? We heard from Friedrich Merz yesterday saying that the system was no longer appropriate, that they had to be revisited. We had that walked back a bit by the finance minister.
No, I mean, as far as and again, I mean, I've come out of a G7 meeting now, and I mean, Germany is a strong supporter of the global minimum tax arrangements as they've been negotiated through the OECD G20 inclusive framework, and of course, European countries were among the first to implement the global minimum tax arrangements through a relevant EU-level directive, and I'm very confident that Germany and other countries across Europe will continue to take this very important reform forward.
So at this point, no other country is seeking a similar situation to what the U.S. has negotiated?
Well, the U.S. was the first country in the world to essentially impose a global minimum tax on its internationally operating businesses, U.S. headquartered internationally operating businesses. And so, you know, what is yet to be finalized, I mean, what the G7 has assessed and reflected in a statement, which was an important statement, is the opportunity for side-by-side arrangement with a clear focus on making sure that this doesn't create new risks of bias erosion and profit shifting, that it does preserve a level playing field, and the US continues to be engaged through the OECD processes, but to come up with a pragmatic side-by-side arrangement that helps to preserve the policy objectives, which is to make the international tax arrangements fair and work better, to preserve a tax basis for governments, but to also provide certainty for business in terms of the way international tax arrangements operate. So we're preserving the policy objectives, but we're coming up with a pragmatic way, and that is the discussion now that will happen in the broader inclusive framework on how the US system and the OECD G20 system can operate in a complementary way, the most appropriate way possible.
And the OECD itself is also one of the great pillars of these multilateral organizations, trying to bring countries together to cooperate economically. Of course, the United States is also is the largest funder of that, and there's been some doubt about the U.S.'s commitment to these sort of initiatives. Are you confident the United States will remain a supporter of the OECD and that funding will keep flowing?
Look, I mean, I can't speak for the United States, but you're right. I mean, the United States is an incredibly important founding member of the OECD. In fact, you know, we started our life as the Marshall Plan Secretariat, as the Organization for European Economic Cooperation. The OECD is very much a US diplomatic foreign policy success story, and all of my interactions with the US government, with US business and with stakeholders in the United States is that there is very strong support for the work we do. I'm bringing together like-minded market-based democracies from around the world, focusing on policy best practice and development of best practice standards. But you know, in the end, I mean, it's, of course, I mean, these are matters for the United States to consider through its internal processes as appropriate.
Right, Matthias, Corman, thank you so much for your time here on the sidelines of the G20 meeting. Outside of Durban, South Africa, there is sort of continued support for that initiative for the global minimum tax that came into a little bit of doubt after the United States wanted some amendments to it, seemingly moving forward with the support seemingly also of the Germans, where there was a little bit of doubt as well.
Bloomberg's Oliver Crook at the G20 finance ministers in South Africa. We thank you so much. We're just a couple of moments away from the opening trades across Europe, which gives, I think, just enough time to get Mark Cudmore's thoughts on the week?
Yeah, so I think going to the week ahead, the Japanese election is the weekend event, and I think that's going to be really important globally and for cross-asset. If we get an outcome which is negative for JGBs again, and we see another steepening of the curve, another softening the yield, I think that will spill over globally. Not because there's so much of the direct crossover, but that fear is getting global now. And if we see some more pressure on long-end bonds, I think that'll make it tough for stocks next week. And the reason I think that'll be the marginal factor for stocks is because the other two competing factors are earnings, likely to be positive next week, and a negative is the kind of looming trade deadline. But that's not next week, it's just that it's getting closer. So I think between those two, they kind of cancel each other out, and I think what happens to bonds will be the side of the story. What happens to bonds might be led by what happens in Japan. So really, Sunday will set us up for the week.
The contagion effect out of Japan, crucial as well. Mark Cudmore, his final thoughts. He's been joining us all week. We thank you so much for doing that. Coming up, of course, it is the opening trade. Futures are pointing positive. The outperformer this morning is France, higher by 0.5%. It's fascinating here that we are seeing the outperformance, given France has taken a little bit of a beating this week as well, but the DAX right on its heels. Light volume, light liquidity. It is a Friday. It's a summer Friday. It's a European summer Friday. We'll see how much of that shakes out, of course, at the opening trade across Europe. Stick with us. That conversation next. This is Bloomberg. There are competing narratives in this market. On the one hand, you have this idea that the United States, their era of exceptionalism is indeed over, that any sort of threat to Jay Powell and the Federal Reserve's independence is actually a negative for the markets. That's what we saw in Wednesday's session. But yesterday seemed to be a little bit of a turnaround. Strong economic data suggesting that the U.S. is still growing, combined with the idea of potentially a rate cut fleeting these markets. And that's kind of what you saw in this story, this idea that as soon as the U.S. kind of came in online, you did see a rally on your hands, to the point that you saw both the Stock 600 and the S&P 500 close higher on the day. Today, the party continues. When you look at the futures picture, green on the screen, but remember, it is Friday. It's a summer Friday. Light volume, light liquidity is your story. Your outperformer this morning is the DAX, higher by 0.4%. But really, every major market across Europe decidedly higher ahead of the open, Lizzie.
Yeah, I want to zoom in on the FTSE, and specifically I want to zoom in on Burberry. It's one of our top stocks to watch this morning. Results coming out earlier, sales falling less than expected because of this turnaround plan under the new CEO, Joshua Schulman. Sales in the Americas actually seeing the strongest regional growth, so we keep an eye on that stock. Also, another eye on Reckitt. It sold its home care brands to Advent in a $4.8 billion deal. So that's most of the home care business going to the private equity firm. So we watch that one. And then SAAB as well, in your defence sector, boosting its organic revenue forecast for the full year. Of course, a sector that's very much in focus given all of that fiscal spending on defence. So we watch SAAB at the open as well, Kriti.
Absolutely, and surely something that's going to kind of perhaps help the DAX open as well. There's plenty of individual stories out there really showing up at the surface, but of course we are seconds away from the opening trade. But remember, light volume, light liquidity, we might get some of these markets open faster than we are usually expecting. And that does it. It is that time of the day, the opening trade. The FTSE 100, again, pointed higher just as futures suggest there. But look, there are plenty of earnings, plenty of sales stories. We continue to monitor the idea of a tariff read-through. We saw a couple of warnings throughout the week from the likes of Diageo, for example, from the likes of Volvo Cars, among many others. And we're ending the week on a high note. But perhaps that's because the volatility was really baked earlier into the week. The Stock 600 opening higher by 0.2%. But the FTSE 100 is flying higher by 0.4%. The IBEX as well. The DAX certainly higher. And the CAC 40. This tells you, the speed of opening tells you, Lizzie, light volume, light liquidity. But I wonder if there's a couple of individual movers driving that FTSE outperformance.
Well, let's go to the ones I flagged. So Burberry's up 5.4%. As I say, they had sales falling less than feared amid this turnaround plan. So outperformance off the bat from the fashion house. Also, Reckitt Benckiser at 1.6% at the open. And SAAB, as we say, boosting its organic revenue forecast, and those shares up 5.4%. So when you look at the sectoral breakdown, you've got almost every sector in the green. Energy leading the gains, up more than 1%. Basic resources not far behind. Construction and manufacturing not far behind that as well. Autos and parts, the only one that's in negative territory this morning, but it's only just in the red. Stellantis is what's dragging that down at as it seems at the moment. Not sure what the story is there, but we can have a look at that. But when you look across the continent, as you say, it's a summer Friday, thin volumes, but we are up 0.4% when it comes to Euro Stoxx 50.
Absolutely. It's a fascinating one. When we look at the downside moves, just because you explained the upside ones, you are seeing some of the heavyweights actually pull back a little bit. And perhaps the ones that are catching my eye right off the bat is Novartis and ASML. Remember, Novartis did come in yesterday and actually talk to Bloomberg about some of the tariff impact there as well. The market down about 0.9%, seeing a slight ripple effect when it comes to some of the other healthcare stocks. From an individual basis, that is your key downside mover. ASML also very much a part of that story, down about 0.8%. But remember, ASML had gotten a big boost earlier in the week, given the U-turn when it comes to the CHIPS policy out of the United States. But there are some warnings, some demand warnings that could be feeding into like ASML and some of their international partners and, of course, competitors as well, Lizzie.
Well, let's get at a bit of analysis on what's going on in these markets. We can speak to Chris Watling, CEO and Chief Market Strategist over at Longview Economics, and I'm pleased to say he joins us around the table this morning. Chris, welcome to the programme. You've been writing about summer turbulence, but all I'm seeing this morning is green across my screen. We're expecting a stronger session to end the week stateside as well. Where is this summer turbulence going to come from? Is the cliff edge going to be August the 1st?
Well, I mean, summer's typically a seasonally tough period, but actually markets in the US haven't done that much in July. They're sort of edging to new highs, but they're not. They've lost a lot of their momentum. That momentum we had all the way from April all the way through to really late June into the beginning of this month has stalled out. And yes, they're edging to new highs on the back of some earnings, but not aggressively. And I think they're just a bit tired. They're overbought. They look very overcooked relative to bonds. Bond yields are backing up and squeezing the equity market. And I think they've become almost overowned by quite a lot of people. You know, there's been a lot of movement into those equity markets. So there's plenty of things to worry about, I think.
Well, some people have been talking about this approaching bull market territory. Do you buy the dips here, or how fast could the rally unravel? Could we go from, you know, you're looking around 6,300 right now. How fast could that turn into 6,000, for example?
Well, the market could quickly give back 5, 6, 7% over the course of summer. I don't think that would be difficult. But yes, I do think you want to buy the dips. I do think it's not a retest of the lows. It's not a retest of the April lows. That's not what we're calling for. But there is a need for some consolidation, some give back, a bit of a pause. There's volatility. The US macro, I know we had good retail sales, but the trend is not good in the data. And frankly, I mean, it's hard to see how this economy is still delivering retail sales numbers like that. And I think it'll have to stall out a bit. So that you've got those risks when you look at the equity market. But yeah, I would take weakness as an opportunity to buy. We're in a bull run. We cleaned out the system in April properly. Positioning was fully cleaned out at those lows. And so, you know, the bull run's likely to have a year or maybe 18 months in it. So, yeah, buy the dips.
Well, that's on the market basis. Let's talk about the economics specifically as well, because you wear two hats on that front over at Longview. Talk to us a little bit about the tariff read-through here. It's been 3 months. We've started to hear some profit warnings, some margin compression from some of these earnings. But investors are looking through it. How digestible are these tariffs?
Yeah, it's funny, isn't it? Investors always look through these things until they don't. I mean, in many ways, they are quite digestible. I don't think they're going to push the US into a recession, but they clearly have an impact. There is a clear fiscal tightening at the moment. We saw last month that sort of tariffs running at about sort of high 20 billions for the month in May, I think it was, wasn't it, that we had reported the back end of last week. And so that's a run rate of 240 billion fiscal tightening per annum in the US. So some of it's swallowed by corporates, some overseas corporates, some by the consumer, but perhaps not as much as people think. But so clearly it's causing problems in the US economy. It's part of that slowing dynamic that we're seeing. But I don't think it's going to push the US over into a recession.
When it comes to that call, though, how much of the currency component plays a role? We just had Netflix earnings in the last 24 hours or so. Massive gains, but a good chunk of that was because of that weak dollar story. How much of the currency is swaying the overall reception?
Well, currency is part of it, but normally you'd say if you're going to put tariffs on, the currency would strengthen. And of course, It's been weakening. So, you know, really tariffs are swallowed by overseas companies, domestic companies, currency, or the consumer. And it doesn't look like the currency's absorbing any of it because it's going the other way. So I don't think the currency is really a factor at all. I mean, it's companies absorbing it basically in their margin, a little bit of it at the consumer level.
Two things. You mentioned about the tariff rate. What effective tariff rate would trigger a recession in the US?
Well, great question. But we're probably going to end up 15 to 20%, so probably not that. But it's clearly going to deliver part of a slowdown. But try doubling it or making it 50%. I don't know. I mean, it's very difficult to know exactly what rate would generate that. But yeah, I think, we seem to be effectively getting by. The economy is clearly slowing, as I say, but we're getting by without the recession at this tariff rate. So, yeah.
And on the dollar story, we're having a down day today because of the Waller comments. I do wonder how long that lasts. And I noted earlier that, this is the best month so far for the dollar in 2025. Are we overplaying the dollar weakness story? And how weak does the dollar have to get before you make US equities attractive to foreign investors again?
Well, it's hilarious, isn't it? I mean, the market narrative swings from one thing to the next. I mean, in January it was American exceptionalism. Now it's the dollar's going down forever. I mean, it just doesn't work like that. I mean, markets don't go in straight lines. I mean, we're very oversold on the dollar. Sentiment's very bearish. We've seen that in many measures over the last couple of weeks. And I think we're due a counter-trend rally, and that's what we've been calling for. And quite right, too. I mean, markets mess people up. When there's a consensus, they mess them up. And, for example, maybe the lack of a rate cut in the US adds some stability to the dollar. You could argue that the other way around, but clearly there's an argument for that as we push back the rate cut over the last few weeks into September away from July, and maybe not even in September. So I think the dollar's got a little bit of underpinning short term from that interest rate support, and it's really a consensus bear. And therefore, I think it's due a bit of a rally, a bit of a counter-trend move. But that doesn't preclude the idea that long-term we are in a dollar bear market.
The dollar is notably diverging from the bond market to the point that a U.S. 10-year has been range-bound for, I want to say, the better part of this year, 420 to 460. We're at 443 right now on the 10-year. We talk a lot about the ripple effect of the currency weakness on the stock market on both sides of the Atlantic. Talk to us about the relationship between bonds and stocks right now.
Yeah, well, like you say, bond market's not doing much, so it's not really driving too much. I mean, what's interesting about the stock market is your sort of typical go-to couple of things you would say with bond yields is, of course, defensives, up or down, and then, of course, yields backing up. You'd argue there's a bit of a pinch point for equity markets, which I think we might be starting to see. They've backed up a bit over the last few weeks. But defensives are deeply oversold relative to the rest of the market, which is actually another good reason why equity markets tend to stall out and have a bit of turbulence. So you're getting that signal from that part of the stock market that is linked to bonds. But no, I think bonds are attractive here. I'd be a buyer of bonds. I don't see why yields don't go lower. Really, the US economy's got fiscal tightening at the moment. It's had tight money for a couple of years. There are large parts of the US economy that are really struggling. And therefore, with fiscal tightening, you need lower yields to kickstart the private sector side, the housing side, all this kind of part of the US economy. So we're a buyer of bonds. We have been since January this year, and I think that still makes sense.
But sorry, go ahead.
I was going to say there's an argument when it comes to the right time to buy bonds as well. There's an argument that as we approach the X date on the deficit in the United States, there might be a better time to clip the coupon, a better time to hop into the yield.
Well, people worry about this fiscal crisis. I mean, the reality is I think that's wholly mischaracterized. I'm totally with Steve Eisman on this. I mean, we're set, the market knows what's going on in terms of the deficit. And actually, the tariffs are probably going to pay for pretty much the whole thing. So how fiscally poor is it? It's in the price. So I don't expect much higher yields from here. I think lower yields is what you need. And I think we'll get those over the course of the next few months, possibly over the summer if we get this turbulence in the equity market.
But when you've got the president weighing on the Fed chair and funding his fiscal plans with T-bills, does that not, Chris, add up to fiscal dominance?
Yeah, sure, there's a little bit of that, and that's a little bit of a concern, and that maybe adds a bit of a risk premium into the bond market, absolutely. But, there's a lot of people on the Fed committee. It's not just the chair, and he's not going to get rid of all of them. And I know we had all this chat from Kevin Walsh yesterday, which I thought was kind of interesting. There's an element of that, but I think you can overplay these things, and these will become popular narratives in markets at certain points in time. But the reality is the US economy is softening, and yields therefore need to go lower.
All right. Chris Watling, CEO and Chief Market Strategist over at Longview Economics. We'll see how low those yields go. We thank you so much. A quick check on the Core 6, the heavyweights, of course, that move this market. And right out of the gate, there's only one underperformer in the Core 6, and that, of course, is ASML, down about 1.1%. But one of your biggest weights on the stock 600 this morning. Your outperformers go right to France. LVMH is the biggest mover, higher by 0.9%, right alongside Nestle, up by about the same amount. If I didn't know any better, I'd say it was a defensive trade on our hands, but ASML, not really a part of it. Let's get some check on some of the individual stocks on the move. Chloe Melly is here with more. Chloe.
Good morning, Kriti. Let's start with luxury this morning. So Burberry sales did fall over the last quarter, but crucially, they fell less than expected. And that's what's driving the stock move this morning. We have shares up 2.2%. It seems like the turnaround is currently working. So Burberry is really trying to refocus on the classics, you know, the trench coat that it is known for. And that seems to be bearing fruit so far. So quite encouraging move from Burberry this morning. Moving on to the defense sector, because SAAB in Sweden, and SAAB raised its organic revenue forecast for the year. And that's pushing shares almost 10% this morning, and probably will have an impact on the rest of the defense sector in Europe as well. That's on the back of really strong defense spending in Europe. Moving on to a little bit of a more negative story in the steel-producing sector. So Salzgitter issued a profit warning, and shares are down 12.6% this morning on the back of that. Analysts are expecting more consensus downgrades across the sector because the near-term outlook doesn't look too good so far. And then finally, Vestas Wind System is up more than 10% this morning. It just got raised to an overweight rating at JP Morgan, who said that that wind power installations are going to pick up, and that will be benefiting Vestas. So really up this morning, in the green, definitely.
All right, Chloe Melly from our equities team, we thank you for that update. On some of the stocks that we are watching at the open, we have European equities broadly in the green across the continent, up 0.25% when it comes to Euro Stoxx 50, about the same on Euro Stoxx 600 as well. But coming up on the programme, we're going to go live to the G20 in South Africa. Finance chiefs gathering under the cloud of the trade war. And we're going to be speaking to the Australian Treasurer next. Jim Chalmers up next. This is Bloomberg.
Welcome back to the opening trade. About 17 minutes into today's session. Green on the screen across the board. France, the notable outperformer, higher by 0.5%. Light volume, light liquidity, of course, key aspects of this market. In the meantime, we've got one eye on what's going on in South Africa, where the finance minister says sustainable financing and global imbalances have been key sticking points as heads of the world's largest economies gather for the G20. For more, Bloomberg's Oliver Crook joins us on location. Ollie.
Yeah, that's right, Kriti. We're just here outside of Durban for the G20 finance ministers and central bank meeting that's been going on here for the last couple of days, wrapping up today. Hopeful that there will be a bit of solidarity and a communique coming a little bit later. We're very pleased to be joined by a guest, Jim Chalmers, who is the treasurer of Australia. Has come a long way for this meeting, so thank you very much for taking the time.
Thanks for the opportunity, Oliver.
Yeah, I think we have to start with the elephant in the room. 2 weeks away from this Trump deadline. What is the status of negotiations between Australia and the United States right now?
Well, Australia has the baseline tariff, the 10%, and some additional areas like steel and aluminium, copper, pharmaceuticals. And so we're engaging with our counterparts in the US, like almost every other country is in the world. We're pretty well placed, and we're well prepared to deal with these tariffs. The direct impact is relatively manageable. Our bigger concern is the impact on global demand of all of this uncertainty and volatility and unpredictability, which puts global growth and indeed global inflation at risk. And so in our modelling, the bigger risk comes from the impact on the global economy rather than the direct impact.
Okay, because 10% is basically, as far as we can tell, the lowest possible deal. That's effectively what you will have with the United States. Are you happy with that, and does that warrant retaliation or no?
We've decided to go for resilience in our own economy rather than retaliation. You know, the 10% tariff is the lowest of any countries, but you know, we've made it really clear that we think the appropriate tariff consistent with our trade agreement is zero. We see these tariffs as self-defeating. We see them as an act of economic self-harm. We've made that very clear. bad for the US economy, bad for the global economy, and therefore not good for Australia.
Do you see any progress possible on steel and aluminum?
Well, it remains to be seen. I mean, we've been engaged more or less constantly for some months now, whether it's steel and aluminium or some of the more recent announcements around copper and pharmaceuticals. Our approach is to engage at every level as much as we can to get a better deal for our workers and our industries, our exporters, our and our investors. And that approach will continue to guide us.
And in terms of the negotiations around pharma, we've heard 200% as a possible figure from the United States. Are changes to Australia's pharmaceutical benefits scheme, is that something that's on the table because the Trump administration has been very focused on non-tariff barriers? Is that part of the conversation?
Absolutely zero chance. We couldn't be clearer. Our pharmaceutical benefits scheme is a crucial part of our architecture, our policy architecture. It's something we're very proud of. We've made it really clear that we're not prepared to negotiate or diminish or weaken the PBS in order to get a deal. We've been clear about that from the beginning. We're working through the potential consequences of pharmaceuticals being caught up in these escalating trade tensions. We do have quite a substantial export offering into the US when it comes to pharmaceuticals. But how this potential tariff might work, we're working through with the industry and with the administration.
And I'd like to also get your appraisal of the evolution of the multilateral kind of cooperative system, because obviously it's been dealt quite a shock over the last couple of months. You sit sort of interestingly between the nexus of a lot of different sort of spheres of influence. In terms of the conversations that are happening here, how is the G20 and the sort of larger global framework of cooperation dealing with this U.S. situation, and what does the sort of potentially further cooperation look like?
Well, I've been involved in the G20 in different roles for a big chunk of the last 2 decades, and we've been through 4 economic shocks in that period. The reason this one, the 4th one, is different to the first 3 is that it's primarily induced by policy, by decisions taken around tariffs. And so I think what that means for this type of multilateral engagement is that people recognise here that at a time when there's lots of volatility, uncertainty and unpredictability, the best defence against that, the best antidote to that is more engagement, more resilient economies, more robust supply chains, more reliable markets for our exports. And so I think that's really the colour and the context for these discussions. And from an Australian point of view, Australia is a huge believer in multilateralism. We're a huge beneficiary of free and open markets, and so we come to these discussions in that light.
And so concretely, where do you see kind of the most motion sort of being affected in that, in terms of different relationships with countries, ones that you maybe have not talked to in the same way in the past? How have you seen that sort of changing concretely?
I just think there's a real recognition here that when these tariffs and escalating trade tensions, the uncertainty that comes from that, but also from conflict in the Middle East, conflict in Eastern Europe, a whole range of uncertainty. I think the heartening message from the colleagues here that we've been engaging with is people are not retreating into their own corners. They're working out how to make our own economies resilient. That's a big part of the Australian agenda as well. But we're trying to de-risk these relationships without decoupling. And I think that's a major theme. It's a heartening theme because the alternative would be to pretend that at a time when these trade tensions are escalating and these conflicts in important parts of the world, to pretend that we can just retreat into our own corners. That, again, I think would be self-defeating. It's certainly not the Australian strategy.
And you mentioned defence as one of these sort of issues. There's been a huge amount of pressure from the United States for allies to spend more on defence. You saw that most concretely in NATO a couple of weeks ago, where you had that boost in pledges for 3.5% effectively of defence. Do you think Australia could get to that figure at 3.5%? Do you think that would be appropriate to join sort of allies at that level?
Well, first of all, it is a big part of the conversation here, particularly with European friends, how they'll find the 3.5% of GDP and how they'll account for the other 1.5% of GDP for national security related spending. For Australia, we are already by our standards, quite dramatically escalating our defence spending. We're taking it from 2% of GDP up to 2.3 at the start of the next decade. That already represents tens of billions of dollars in extra investment. It's a much higher trajectory than when we came to office 3 years ago. And so we are increasing our defence spending. We make those decisions, trading them off against all kinds of other budget priorities. But we say to American friends and we say to the world more broadly, we are already increasing our defence spending because we think it's important at a time where we are where we are seeing this heightened uncertainty in the world.
And given just sort of the global volatility, uncertainty in the outlook, how confident are you of your inflation forecast and your growth forecast? How susceptible do you think those are to downward revision?
Look, there's always an element of uncertainty when it comes to forecasting economic outcomes, but especially when global markets are extremely volatile right now. But one of the things we're very proud of as Australians is there's only 2 countries here at the G20 that last year had continuous economic growth, inflation with a 2 in front of it, and unemployment in the low 4s. No major advanced economy has been able to, over the last 3 years, maintain that growth and have those inflation and employment outcomes. And so why we're proud of that is we've made very substantial progress on inflation, now sustained progress on inflation. It's given our central bank the confidence to cut rates twice already this year. But we've done that without paying for it with much higher unemployment. Unemployment is now 4.3%, historically low, the lowest average unemployment over the last 3 years for any other government in the last 50 years. We've created 1.1 million jobs, and so our labour market's been a source of strength. We had a little tick up yesterday in the unemployment data, but we've got inflation down without paying for it with a big spike in unemployment, and that's something we're very proud of.
Well, Jim Chalmers, thank you so much for your time here on the sidelines of the G20 outside of Durban in South Africa. Thank you very much. So those are the thoughts there from the Australian Treasurer in sort of multilateralism in the age of MAGA and the path forward here at the G20.
All right, Ollie, thank you so much for bringing us that interview. That's Bloomberg's Oliver Crook out of South Africa with the G20. Of course, we've also been hearing from the South African Finance Minister speaking to Jennifer Sabasaja on the ground there, expecting a communique for the first time in South Africa's holding of the presidency to come today. So that would be a significant achievement for them. Of course, Scott Bessent, the US Treasury Secretary, in his absence has been dominating and the trade agenda dominating as well, although, of course, there are many, many other things that they would like to be focused on at that summit. But Kriti, as we look at the performance of the stock market as we are 26 minutes into the open this morning, Australia, and that conversation reminds me of the miners, and they are one of the best performing sectors this morning. It comes down to partly the performance of iron ore this morning, surging to the highest since early April. It's come off a bit of that high now, but green across the screen for that sector. BHP at 1.4% at the moment. They had a pretty upbeat assessment of their demand in China, and that's spreading across the sector as well.
Absolutely. It's fascinating when the commodity sector has been one that's very exposed to the China story as much as their earnings piece as well. I should mention that Burberry shares, which of course got the trading update at the start of the session, down by 0.6%. Coming up on the program, we switch from public to private markets. Private equity partner firm Apis Partners joining us in just a few minutes. This is Bloomberg. This is the opening trade. About 30 minutes into today's session. Green on the screen across the board. The CAC 40 is your outperformer, though, this morning, higher by 0.4%. LVMH certainly helping that market. But again, light volume, light liquidity, which makes it the perfect day for a conversation about the private markets. Joining us now, Udayan Goyal, co-founder and managing partner over at Apis Partners, joins us around the table. Pleasure to have you. Thank you so much for joining us. We've spent about 90 minutes of the show talking about the volatility in these markets, when we're going to see the public markets start to crack. We know we're coming off of a banner couple of years for the private markets as well. How do you digest that? How do you marry the success of private markets in the last couple of years with the volatility we're seeing in the public ones now?
Well, volatility generally creates both issues and opportunities, right? I think the opportunity that volatility has created, particularly for deploying money from the private markets, what we call the dry powder, into the markets has been actually quite interesting, because it creates situations where you can either find interesting asset sales or stress situations or carve-outs where you can actually take interesting assets out during these markets. So at one level, the vol creates an issue. We've come off a pretty tough rates environment. So last 3.5 years, hangover from COVID, tough rate environment. That's made it quite hard for private equity exits over the last few years. We're almost at an all-time low in terms of what we call DPI, which is the exits, which then translates into money back to the limited partners who are the investors for the private equity community. And so now we're coming out of that a little bit as the rate environment improves. And obviously that creates opportunities now to exit and start to improve where we are.
Well, Udayan, the most common exit is a private company grows with some private funding and ultimately makes it out to the IPO. We're in an environment where capital markets aren't yielding that much success in terms of that path. What are the other options when it comes to deal exits?
Yeah, so 100%. The IPO market's been closed. It's been closed for the last 3 or 4 years. We're starting to see a little shimmer of light right now in the IPO market, but it's literally the beginning. We as a firm, we generally prefer not to do IPOs. We've, I think, done one IPO in our history, and then there's one coming up. Those tend to be in very specific markets where the IPO market tends to be, very resilient and largely in India. But the rest of the world, Europe, other places, pretty hard to do IPOs. So we really focus on strategic exits. So our focus is to go after those companies that are looking to fill a particular gap in their offering, where we've built a company that actually fills that gap. One of the things that we do early on is we figure out, we go and map our markets. We only do financial services. We map our markets, figure out which company has a gap where, and then we focus our attention to going and finding companies that we can invest in, that fills that gap, grow that company up in the 4 or 5 years to the right size, and go back to the same people. And we talk to those people in the beginning. Yeah. We have relationships. We actually talk to those people in the beginning. We get that input in. We actually figure out. So if you are a MasterCard or a Visa or somebody like that, you go and talk to the management. You say, so where do you have a gap? Where can we help you as a firm? Where can we work with you? And that's where, and then they come back and they buy it. And that's where you get the good liquidity. Our liquidity on our first 2 funds is top 5 in the world, right? Top 5% in the world. Since inception. So that's a very important thing. People look for that liquidity.
And when you're talking about that fintech focus, we've been talking earlier about the crypto bill passing and Jamie Dimon talking about the threat from fintech to traditional banking. How big of a threat is that when it seems to be going mainstream?
So I think it's a huge threat. I think people absolutely underestimate just how meaningful and just how transformative Web 3.0 and the whole crypto world is going to be. So you've seen the US administration has done a fantastic job around stablecoin, right? So they've come in, they've created the stablecoin legislation, it's gone through. We're now seeing things like Tether and Circle USD. The volumes are massive. In fact, if you combine them, they're more than Visa and MasterCard combined. So this is really becoming a thing. And some of our companies that are in the money transfer space are now starting to replace the way they move money across the world from the traditional rails, which is SWIFT and all the other things, to essentially stablecoin. So stablecoin is actually becoming a really, really important part of the financial infrastructure. Now, let me put it into context, because it's quite interesting. I was talking to the treasurer of one of the largest companies in the world a few weeks ago, and we were having a little conversation. I said, so tell me a little bit about your stablecoin strategy. And he was like, expecting him largely to say, we do nothing in stablecoin. And he turns around to me and says, well, that's interesting you asked me the question. We are now experimenting with stablecoin. I said, what do you mean? I said, we have operations in 180 countries around the world. We need to move money all these places, right? So if you're running a big industrial conglomerate, you need to have cash in one particular country or cash in another particular country, and you need to do that pretty. And one of the problems with the regular banking sector is 9 to 5, right, or whatever the banking hours in a particular country. Right. So if he needs to move money out of hours, it's very, very difficult. And if he needs to do what's called a cash sweep, where he's picking up all his excess cash and putting it on deposit, he has to do that before the banking hours close. So what he's able to do with stablecoin is run a 24/7 infrastructure. So he's experimenting. Now, that's a bit of a problem for Jamie Dimon and other people, right? Because what happens to their cash management, what happens to how they manage cash, it starts to move away from them into this frictionless world.
But nonetheless, for a lot of people, this is a very scary space. It's an absolute minefield. Yeah. How do you pick the winners if you're going to choose who to back in fintech?
So I think, look, picking the winners always. So one thing is we don't generally go too early. So we focus very much on mid-markets, the companies that are actually generating cash flow, that have proven what we call market fit. So particularly the market fit and the product fit is incredibly important. So by the time we come in, we're starting to see this very interesting trajectory that typically fast growth companies, 20-25%, even more growth. And by that point, we've seen that they've sort of figured out where they fit into that market niche. The other thing that we focus on is investing in expanding markets, right? So if you think about these markets that are expanding, one of the things is we want to be on the crest of that wave, right? And as long as we're on the crest of that wave, and as long as we are maintaining market share, we will grow. And then obviously if we can increase market share, we grow even faster than the market. So I think that's part of the, what we're trying to do. If you think about areas within financial services, great growth. We talked about crypto. That's interesting. So Web 3.0 Web 3.0 infrastructure, stablecoin, super interesting. Embedded finance, single biggest area of growth in financial services. Today, the world's top 30 banks are worth $3.5 trillion. In 10 years' time, the embedded finance world will be worth $7 trillion. It's double the size of the market, right?
Yeah.
So, and then deepening of the digital economy. Every economy becomes more digital. As every economy becomes more digital, we need digital transactions. So you have people playing that. And finally, democratization of finance.
A snowballing effect, clearly. Yeah. Talk to us, finally, if you can, about kind of regional exposure. When it comes to a lot of the private players, there's a big question of maybe that you need scale to perform in this market, and a lot of the biggest American players are operating and deploying their massive piles of cash right here in Europe, feeding on this idea of U.S. exceptionalism being over, and that's something we see in the public markets as well. There's another angle to this, which is that perhaps if Europe is not the moment, Asia is. How are you thinking about regional exposure?
So we're actually unique because we're global, and we tend not to do a lot in the United States. And actually, Dow Jones, HEC, have a global private equity ranking. They do it for buyout, growth, and venture. We sit in with the venture. There's never been a non-U.S. firm in the growth rankings until a few weeks ago. We came in for the first time as a non-U.S. firm as number 2, and there are 3 firms now in the top 10 that are non-U.S. firms. This is the first time, and that actually plays to what you're just talking about, right? Which is finally we're starting to see a little bit of this activity outside of the United States, which is actually delivering huge results. By the way, in the venture rankings, almost all of them are non-US firms, right? So this is what's starting to happen. Now, to your point, I think the first wave was into Europe. So we're definitely seeing that first wave into Europe. You yourself on Bloomberg talked about Blackstone coming in, and I think the number was $500 billion that they're going to come into Europe for the next 10 years. This is definitely happening. The big firms are coming in. But the big firms play right at the top of the market, right? So they're doing very large ticket sizes, very large deals. People like us are pretty much in the mid-market. We're pretty unique. We're playing in that space. And I think to play in that mid-market, you need to have 2 things. You need to be a sector specialist. And by the way, in that ranking that I talked about earlier, almost every single firm, in fact, I think every firm is a sector specialist. So either healthcare, tech, financial services. So you need to be a sector specialist. That's the first thing. And you need to understand those markets, right? So I think people who have an established infrastructure in Europe and now, as you say, coming to Asia, I think Asia is a little bit more tricky, right? We haven't really seen that transition so far into Asia. You have some of the big firms like TPG and others that have reasonable infrastructure in Asia, but Asia is still there. I think the place that people, interesting enough, are going after, the large guys, is actually Japan, which is actually a huge surprise, right? I never thought that they would come after Japan, but Japan's been super interesting.
Well, we're going to talk Japan later in the programme, especially with that election coming up. But Udayan, Goyal, it's so great to have you around the table this morning. Thanks for starting your day with us. Udayan Goyal, who is co-founder and managing partner over at Apis Partners. Well, we started off that conversation talking about volatility. Of course, a lot of it comes back to the tariff chaos, and it's absolutely shaking global supply chains, forcing Chinese manufacturers in particular to rethink their strategies. Now, Bloomberg Originals has been exploring whether they're truly eyeing a shift to production in the US.
Navigating high-risk environments when you can't see what's ahead is no mean feat. But it's the kind of uncertainty Donald Trump's trade actions have forced on China's factory workers.
President Trump ramping up trade tensions again.
The word tariff, music to my ears.
So we're in the realm of just endless tit for tat.
This just kind of indicates how much of a moving target this has really become.
At stake is hundreds of billions of dollars in bilateral trade and access to the world's single largest consumer market, backed by American spending power.
This trade war basically leaves no one untouched, whether that's investors, business people, or officials in any country.
It just seems like every manufacturer in China realizes that they need to have strategies in case things get worse.
2 things are becoming clear, though. One, that finding a replacement for the mighty US consumer is as essential as it is difficult. And 2, that despite all the tariff chaos, Chinese manufacturers aren't rushing to shift production into the US.
Americans don't want to make spatulas. They want to eat hamburgers. And I don't mean that in a negative way. I want to eat hamburgers too, but I'm here in China making the spatulas to do it. Americans don't want these jobs. And to think that manufacturing would go back to the United States is a farce.
And Score subscribers can see the full documentary right here on the terminal or at Bloomberg.com. It'll be available later on Bloomberg Original's YouTube channel as well. Coming up on the program, high stakes for Japan's prime minister in Sunday's upper house elections. We're going to talk FX with Jane Foley from Rabobank as Tokyo struggles to secure a trade deal with the United States. That discussion next. This is Bloomberg. Oil on the rise this morning as the European Union approves a fresh sanctions package on Russia over its war against Ukraine. The measures include a revised oil price cap and now banking restrictions after Slovakia lifted its veto. For more, let's bring in Bloomberg's Ben Sills. He joins us out of Madrid and leads some of our European coverage. Ben, can you just walk us through how all of this works? It feels like this is the first time that sanctions include not just Russia, but the other countries helping Russia.
Yeah, so what this is going to involve is the EU's taking the existing oil cap, which was agreed with the rest of the G7, and they're going to lower it to a price which is going to be fixed every probably twice a year based on market rates, but it's likely to be about $15 below the market rate, we understand. And it also includes restrictions on a Russian-owned oil refinery in India, which could potentially hit the supplies of diesel both in India and also back into the EU.
And so significantly, how significant is this going to be, Ben? Not just in terms of the oil price, but in terms of obviously the geopolitical impact that it's meant to create?
Well, I think it's not a silver bullet, but it's not nothing either. We saw the oil price creep up a little bit this morning when the measures were announced. We've seen also diesel prices increase. At the same time, we know that Russia has well-established ways of getting around this cap by using shadow fleets and that sort of thing to ship crude to countries like India and China. The issue really, I think, is when you look a little bit further down the track to Donald Trump's threats of secondary sanctions on countries who are doing business with Russia. The oil cap in that context could become a lot more significant. But of course, that depends on whether Trump is ever really going to get serious about following through on those threats against Putin.
OK, Bloomberg's Ben Sills, we thank you for the update on that latest on Russia sanctions. And of course, this feeds into the central banking story, the inflation story as well. Fed officials divided over the central bank's rate policy path, and some encouraging further cuts, but others supporting a wait-and-see approach.
I believe it makes sense to cut the FOMC's policy rate by 25 basis points 2 weeks from now. And looking to later this year, if, as I expect, underlying inflation remains in check, with headline inflation data reporting modest but temporary increases from tariffs that are not unanchoring inflation expectations, and the economy continues to grow slowly, I would support even further 25 basis point cuts to move policy towards neutral.
So I'm of the mind that, the summary of economic projections we put out, which had 2 rate cuts for this year, I think that's a reasonable outlook to have.
I find it appropriate to hold our policy rate at the current level for some time.
Well, the dollar moved lower on those comments by the federal governor, Christopher Waller, saying that policymakers should cut rates this month. But how long will that last? Joining us now to discuss is Jane Foley, FX strategy head over at Rabobank. Morning, Jane. Thanks for being with us. Let me ask you that question. Is this dollar weakness story overblown at this point?
Well, if we look this month, I think the dollar is still the best performing G10 currency in the month to date. So we have been having this rotation, back into the dollar this month, just as we had really from last month, this rotation back into US stocks. And I think there may still be a little bit more, catch up for the dollar to take. So a little bit further gains for the dollar. But clearly there is noise out there. And clearly, the comments from Waller, they did impact asset pricing, and they do impact psychology, because we know that Waller, for instance, is as one of the candidates that could be out there to replace Powell. So, the market is also thinking, is this a political move by him? After all, yesterday's data, the retail sales, the initial claims were a little bit better. So they don't necessarily support the view of an immediate interest rate cut being needed from the Fed. So there is this concern that already the very dovish tone of Trump is soaking in to that of some of the Fed members' talk.
Well, of course, Trump sparked all this speculation that maybe he was going to oust Chair Powell, and then he flew the kite, he brought it back down again, but we did see a market reaction. How would that market reaction to compare to what would actually happen if he did oust the Fed chair? Because many saying that this was, you ain't seen nothing yet.
Well, this is it. I mean, I think everybody will agree that, the issue of Fed credibility is really important, in terms of just an anchoring of inflation expectation and anchoring of secondary inflation. So, for instance, things like payroll increases, if that's why credibility, that's why inflation expectations are really important. I think everybody agrees on that. But, there are a number of economists out there, very high profile economists who do believe, a bit like Trump, that the Fed, needs to cut interest rates now. And that view, of course, will counter the concern that the Fed could lose its independence. Many think, well, this is a reasonable view, and whoever the president does appoint is likely to be an economist with good credentials anyway. But of course, this is an ongoing, a developing debate. We'll have to see what really does happen, because there is still the big concern by the other side of the debate that the credibility of the Fed, could be compromised.
Jean, the Fed credibility is one aspect to the dollar moves, perhaps, in the interest rate story. The other is not only tariffs, but the deficit story as well. As we approach the X date in late August, early September, whenever it does come, I'm curious if concerns around the deficit, which are largely expected to move yields higher, are dollar positive or dollar negative?
I think that's a really good question, because, if you'd asked me that last year, I think everyone would have said, well, this exceptionalism story of the US dollar means that, generally speaking, the government can borrow at lower interest rates than would be otherwise. It can run a bigger budget deficit than would be otherwise. I mean, bear in mind, of course, the US budget deficit at the end of last year was bigger than France's, and we were all panicking about France's. That, to me, is the dollar's exception, the US exceptionalism story. But, of course, roll into the first part of this year, and we were all saying, has that exceptionalism story been stripped away? But, I think probably what we were seeing in the first part of the year was just overinflated expectations, perhaps for the US economy, overinflated expectations for the dollar. And those now have been taken out. The market is now probably short of the dollar, certainly not long. And I think that suggests that the US dollar is now going to be a lot more resilient to bad news, perhaps, in reflection of the way it has been for years, than it was in the first part of this year.
Jean, that, of course, is the dollar story, and we'll see how that all shakes out. The other story, of course, we've got a very close eye on is what's going on in Japan. The upper elections due this weekend. Can you just walk us through your scenario analysis of what kind of impact we might wake up to when it comes to the yen on Monday morning?
Well, of course, we know that the LDP did lose the coalition at the end of did lose the lower house majority at the end of last year, and that was probably a badly timed election call from Ishiba. There is speculation that if he were to lose the upper house majority this summer, well, he could be forced to resign too, and then we could get another leader of the LDP, another prime minister, who could be willing to spend a little bit more money on fiscal policy, which clearly has implications for inflation and for the long end. But, whilst there will be knee-jerk reactions on Monday and through the end of next week and perhaps through to the end of the month, I do think it is still the Bank of Japan that the market is going to be focused on. And we've got to remember, at the end of this month, the Bank of Japan could revise higher one of its inflation forecasts. And if the market still believes that the Bank of Japan is still in a cycle of hiking interest rates, albeit perhaps not till the end of this year, beginning of next year, then I think the yen will still slowly come back and win back some ground.
Well, yeah, we saw Japanese inflation still elevated in the overnight data. We've got the Treasury Secretary Scott Bessent in Tokyo today, meeting Prime Minister Ishida. Given how slowly the trade progress is going, Jane, how much of a hawkish message do you think that we will see out of the BOJ?
I think they will, of course, be careful. I mean, the meeting from the Bank of Japan is July the 31st. I think they'll be hoping that there is some positive news on trade after that. The election, the timing of the election has certainly impeded these trade talks with the US because, after all, Japan doesn't want to be seen as losing too much face, giving in to Trump, giving in or making too many concessions. I think Japan went into these trade negotiations thinking it had a strong hand. It is, of course, the largest provider of FDI into the US. It's got, as a base for US troops, for instance. It's been promising to step up its military might, to buy more weapons from the US. Some of the car manufacturers have been promising to expand their facilities in the US to make use of the US consumer, if you like. So they thought they had a good hand. They do not want the auto sector to be, to have to take too many concessions. So, but I think once the election is done, I think the risk of getting a deal certainly goes up.
Absolutely. Jane Foley, head of FX strategy at Rabobank, previewing the upper election in Japan this weekend. We thank you so much. Speaking of what's going on this weekend, there's a couple of fun things on the agenda. I hear the Open Championship is coming up, as well as the Tomorrowland Festival, Lollapalooza in Paris. I know there was a French edition. And some boxing, which I hear you have some interest in, Lizzie.
I'm going. It's in Wembley. I have no idea anything about the boxing. I'll be very excited for all the sweat and the blood. Apparently it's a 27-year-old and a 38-year-old, and the Ukrainians unbeaten, and the Londoners going to try and do what no one's done before.
News you can use.
I'll be ringside.
Absolutely. It's a fascinating one. Well, speaking of the weekend, of course, there's plenty to catch up on. The Bloomberg Weekend newsletter bring you a collection of interviews, ideas, stories that explore the fascinating places where finance, life, and culture meet. But, of course, for Bloomberg television purposes, there's one interview you want to watch, and it's with Fed's Christopher Waller this morning, 1 p.m. London time. Stick with us. This is Bloomberg.